Hey Bowtie Nation, Joseph Hogue here with your 2024 investing plan, how to invest, and the 10 stocks I'm buying right now. By historical standards, it should be a very good year for investors. While the Fed was raising rates, as we saw in 2021 and 2022, stocks underperform and you are better off with those higher rates in a money market fund on cash. But now the Fed has been on hold since July, is likely staying that way until rate cuts. The stock market has jumped more than 30% since the low of October of last year, just in anticipation of that rate pause environment. But we're expecting the next phase to start around May of 2024, leading us into that multi-year bull market with returns from 12 to 15% and more for some of the stocks I'll show you today. We're going to start with a look at how the sectors and the industries did this year to show you where the best opportunities are in 2024. I'm going to then outline the trends to watch for in the next year and those top 10 stocks that I'm buying right now. Don't forget to join the community by tapping that subscribe button so you don't miss a single episode, and don't miss our next video, how to invest $1,000. I'll show you 3 different portfolio ideas for different types of investors, from dividends to growth and retirement portfolios for safety. I'm going to be using the Yardeni report on sector and industry performance for this year. That's going to give you a great picture of what drove stocks this year and really where the opportunities to invest in 2024 are. Yardeni puts out some great charts, but never any commentary with it. So it's you have to kind of make your own conclusions. And we'll be doing that, looking at these sectors and the stocks and the industries within them. And if we look at the sectors here for the year, it's kind of a jumbled graph, so we're just going to look at the numbers here, looking mainly at the returns next to each sector. The S&P 500 up 20% so far this year. We can see here some of the winners here. Communication services up 49%, almost 50%. Information technology, so tech stocks, up 52%. Some of the laggards, though, that's where we really want to focus on in this video, how to invest next year, finding those bounce back, those turnaround stories. And we can see some of those consumer staples down 5%. Energy down 7%, really hit hard over the last few weeks on those lower energy prices. Financials have been lagging the market, 5% increase this year versus that 20% for the market. Healthcare down 3%. Then we have utilities and real estate. Real estate only up 2% so far this year against that 20% market performance. And utilities, the worst sector overall, down almost 11% for the year. So we're going to look at the industries within each sector. Remember, a sector of the economy is just a bigger picture part of the economy. Within each sector, you have the industries. So the companies that sell very similar types of products within that sector. So within consumer discretionary, you'll have things like retail, so apparel, broadline retail, apparel retail. You also have housing, home building, and auto stocks within that consumer discretionary sector. Obviously, very different types of industries within each. So we want to look at the performance within each and see if we can find some opportunities in there. Sector overall, consumer discretionary has done 36% upside so far this year. Very strong consumer spending, but very likely to look a little bit weaker into next year as people really get into those student loan payments, as the job market is still strong but slows down a little bit. And some of the valuations are a little stretched, especially here in retail. So we can see that, very strong gains other than casinos and gaming, only up 6% for the year so far, but broadline retail and apparel retail up both 12 and 71% there. So not quite the opportunities here we see in retail that we saw over the last year. Still within that consumer discretionary sector, but within housing and auto, we do start seeing some opportunities here. We did see home builders jump 60% this year. Really a theme that I pointed out a few months ago, that because home prices have stayed high, people aren't putting their house on the market because they're locked into those 3% and lower rates. A lot of home builders or homeowners, something like 40-50% of homeowners, have rates so low they're afraid to sell their house. So just not very many houses on the market. Home builders are taking advantage of that to fill in that supply gap. So home builders up 60% so far this year. Probably not a whole lot of opportunity left on those valuations. But we do see things like household appliances, stocks like Whirlpool down to multi-year lows and providing very good dividend yields. So I'm going to talk about some household appliance stocks later on in the video. Auto parts and equipment. This is something I've been watching for. Been in AAP, Advanced Auto Parts, for the last couple of months, doing very well on that. I think that is primed to rebound still. Ticker AAP, Advanced Auto Parts. We can see the auto parts and equipment industry within the consumer discretionary sector down almost 12% this year. And really kind of something of an anomaly because the auto parts industry is coming into a very good era, okay? The average age of cars on the road is somewhere between 12 and 13 years old. That's right in this sweet spot between 10 to 15 years where cars have to be taken in more often, so they need more of those aftermarket parts. So a very good age, a very good next few years for revenues for these auto parts stores. That's something to take advantage of over the next year. So AAP, I do like some of the other auto parts retailers, but especially AAP there. Here in consumer staples, you can see the sector is down 5% for the last year. Now that is very much underperforming the market, that 20% return on stocks in the overall market over the last year. And a lot of this is an inflation play. Okay, a lot of these companies that sell things you have to buy, or things that you're going to buy even if the economy does well. You know, those brewers, the beer, the consumer staples, the retail, household products, personal products, soft drinks, and tobacco. Things that you're going to buy whether the economy goes up or down. So normally very stable cash flows, but a lot of these companies haven't been able to pass on those prices, those higher inflation prices onto consumers. So they've been seeing those profit margins fall a little bit, as well as just the higher interest rates pulling investors out of these stocks. These stocks are dividend plays. So, you know, it doesn't make much sense to get a 2 or 3% dividend on a stock when you can just go into the cash money market account and get a 5% yield on your cash. So investors being pulled out of consumer staples. There are some opportunities here. We can see here in drug retail down 38% over the last year. Stocks like WBA, Walgreens, Boots Alliance, which we've been investing in over the last month, up about 15 to 20% in that already as the company starts turning around, seeks a sale of its Boots Alliance pharmacy chain there in the UK. So doing very well in that stock. There is still some upside potential in WBA, but also some of those others, CVS, ticker CVS, obviously, very large retail pharmacy chain, and will continue to do well. But just the sheer sell-off across all of these consumer staples names, there could be some very strong opportunity for safety names going forward this next year. These stocks aren't going to make you rich, but they will provide a really good dividend yield as well as upside price appreciation in stocks that have underperformed over the last year. Stocks like Coca-Cola, ticker KO, Procter & Gamble, P&G, and some of those other soft drinks, tobacco names like Philip Morris and Altria. Here we are. So we see the energy sector down 7% for the year, which is really surprising. Energy has done so well over the last couple of years, but really fallen apart since that peak in oil around September. Oil now down to about $72 a barrel. Seeing some support here, especially as the government says they're going to be taking oil off of the market, refilling that strategic petroleum reserve. So that should support oil prices right around $65 to $70 a barrel at the minimum. That'll support oil stocks from here. Now down on both supply and demand worries, though, as investors are still a little bit worried about a recession in the United States, slowing growth in China, really not making that demand for energy products. Oil down 7% for the year. I think you can start buying in for some of these longer term names, things like Devon Energy, ticker DVN, Chevron, CVX, and Diamondback, ticker FANG. Could be more pain to come as the economy slows down a little bit further in early 2024, but these are going to be long-term dividend names that are going to do very well. Here in the financials, we see the financial sector stocks up 5% for the year, so also underperforming by a wide margin the rest of the market. This is where we're going to see one of the biggest opportunities for 2024, and one of the stocks to watch that I'm going to be highlighting in our 10 stocks that I'm buying now. The sector has lagged since that March crisis, but the real crash has been in these regional banks. If you look here, the regional banks are down 31% so far this year, and of course it is because of that deposit crisis there in March. What happened is the Fed raising rates by the fastest rate in 40 years, raising it from almost 0 to up to 5.5% in the federal funds rate. That caused a lot of the holdings, the bond holdings, safe bond holdings that these banks have to offset their deposits. The value of those bond holdings came down. Of course, that led to a deposit exodus in a lot of these regional banks. Saw a couple of bank failures. But I think just as investors were surprised at the hit that these regional banks took on those higher interest rates, they're not going to be just as surprised when those rates start cutting out. When the Fed does start cutting interest rates here in 2024, got news of that this week as the Fed started previewing those rate cuts, we're going to see the bond valuations increase. We're going to see those regional banks start looking a lot stronger stronger, and that's one of the big opportunities I think you could see here in 2024. The healthcare sector also negative for the year, which is interesting because healthcare is usually kind of a safety, very stable returns, very stable cash flows kind of sector, but the healthcare sector down 3%. A lot of that is healthcare services, so a lot of the hospitals down 16, almost 17% for the year, but also pharmaceuticals down 3%, biotech down 5%. You do have some very interesting opportunities here as well. Those medical device companies that we talked about a couple of weeks ago starting to look better as they come out of that drug-induced, that weight loss drug-induced sell-off earlier in the year. A lot of those weight loss drugs had people wondering if people are still going to need their diabetes monitoring and their diabetes medication, things like that. We have started to build back on those. So the equipment makers are looking better. Those were only up 1.7% so far this year. Here we see industrial sector only up 10% for the year. So it is lagging a little bit, but no real opportunities here. This is really a mid-cycle story. So when the economy starts ramping up later in 2024, we might revisit this. You're going to see a lot of the aerospace defense, a lot of construction and machinery stocks do really well, but that's probably later on in 2024. So we're going to revisit this probably about mid-year next year to see where the opportunities are in industrials. Same thing here with the transportation sector, up 6.5% over the year. So it has also lagged the market, but this is also a little bit later economic cycle kind of story. I want to revisit this later. I know I'm rushing through some of these sectors, but I'm rushing through the ones where I don't see a lot of opportunity for that early start of 2024. I want to get to those stocks that I'm buying, as well as really the biggest opportunities we're seeing here. Technology stocks. Here we see the technology sector up 52% for this year, have really been the big winners as we get that rate pause environment through. I'm going to explain why that is next, but a lot of these stocks here now just too expensive. If we look at the FactSet Earnings Insight Report on PE ratio, so this is a forward PE, price to earnings ratio, the price of all the stocks in that sector divided by the earnings expected over the next year, we see that tech stocks are the most expensive at 26 times price to earnings, and also well above their long-term average, around 19.8, so 20 times earnings. So tech stocks are now trading 25% more expensive than their long-term average. I do like some of these over the next year, but really no big opportunities as we look at the industries here in the information technology sector. Materials sector is another one that has lagged the market, and there are some bright spots here, but for the most part, this is a later 2024 opportunity than right now. I do like the fertilizer and agricultural chemical producers like Mosaic, that's ticker MOS, CF Industries, ticker CF. Those are both, you see here, diversified or fertilizer and agricultural chemicals down 25.6% over the last year. Is obviously a very stable cash flow segment. We are only seeing more demand for food products, but not as much increase in tillable or agricultural acreage. That means we need to get more yield out of each acre of agriculture. That's only going to happen through fertilizers, through agricultural chemicals. So this is a very good growth, long-term growth industry. It has underperformed over the last year. I think that's where one of the big opportunities are in 2024 and really beyond over the next 10 years in those agricultural fertilizer and chemical producers. I also like the lithium miner Albemarle here, ticker ALB, on a rebound in those EV stocks that we're going to talk about in a little bit here. Here in the communication services sector, we do see the sector overall up 49% over the last year, but Standard & Poor's really just messed up the comm services sector a few years ago, adding really all the internet names and making it this big hodgepodge sector that really includes too much. We're going to look at this in two charts here, but here you see the traditional telecom names that were usually the communication services sector. So things like AT&T, names like Verizon, but I'm really still avoiding these. The cash flow situation is a mess in these. AT&T, Verizon, all of these traditional telecom carriers, they are borrowing billions of dollars to pay those dividends. So that debt bomb is ticking for telecom. A lot of the internet, social media, and streaming names have done well this year, so really looking for opportunities in other sectors. We can see that the rest of communication services sector here, advertising down 2.5%. That started to rebound a little bit as we do see, advertising jump back. So a lot of the social media stocks like Facebook are doing really well. Snap, a lot of those broadcasting down, cable and satellite TV. interactive home entertainment, a lot of these publishing as well as movies and entertainment doing very well. Not a lot of opportunities here in the communication services sector. Here we see real estate, one of the biggest opportunities for 2024. So I'm going to break this apart, talk about this more in those stocks that I'm watching, because I'm really buying a lot of real estate stocks, REITs, real estate investment trusts, as well as some other off of other real estate platforms like Arrived Homes. Interest rates have destroyed property on multiple fronts. You're really on lending, on cash flows, on those property values. So that highest interest rate hike in 40 years, it's been an absolute chaos for real estate, and you see that here in the property returns. We see the real estate sector overall only up 2% so far this year. It was down 25% last year. And a lot of investors forget that, this looks a lot like that 2008 crash when real estate dropped, 30, 40%. But over the next 5 years, real estate was one of the best investments to have, being the top performing asset class with like 4 out of the next 5 years. We can see some of these data center REITs have done relatively well, up 11% so far this year. Healthcare REITs like MPW down 19%, really on a combination of poor real estate valuations, but also those hospital services, and we saw that in the healthcare segment. In the healthcare sector, that those real estate or those healthcare services, those hospitals were really underperforming as well. So it's kind of a double whammy against the healthcare REITs here. Hotel and resorts up 12%, doing relatively well. Some of these multifamily residential REITs, so the apartment REITs down 3%, office REITs down 14%. Now I do think outside of the rest of these properties types that I think could do really well in 2024, office is something you still probably want to avoid. Office demand is still extremely low, much lower than it was pre-pandemic, and not getting any better. They're talking about trying to convert a lot of this office space into residential, which just isn't going to happen. If you know anything about structural code and how office space is built, then it is very difficult, very expensive to convert that into residential apartments. And besides, a lot of these office space in the city, in the metro center, why would you want to live down there if there isn't going to be anything to do because everybody has moved to the suburbs working from home and not in the office? So, trying to convert these office space into residential just isn't going to work. And I don't see a whole lot of opportunity in those office REITs over the next year. But a lot of these other ones, retail REITs down 1.8%, self-storage up 6%, telecom towers, we did very well in our CCI Crown Castle play a few weeks ago, but that's still down 3% for telecom tower REITs. Still some opportunity left in those from CCI as well as AMT, American Tower, some of those other telecom tower REITs. Last sector here before I highlight those 2024 trends and the stocks that I'm buying, but utilities, another major opportunity here. Usually this is very much a safety sector, but it's down 10% for the year. Like others, this is an interest rate story, okay? One, those interest rates really hitting the profit margins for these utilities, but more importantly, really drawing those investors out of these dividend stocks. Much like we saw with the consumer staples sector, we see really the pain across the board in utilities here. Electric utilities down 11%, independent power producers down 36%, multi-utilities down 9%, and water utilities down 14%. But a lot of that, again, is just that investor story, investors being drawn out of there into safer and higher yields in money market. I think investors were surprised about that in utilities this year, but are going to be equally surprised at how fast these bounce back, those stable cash flows for regulated utilities here in 2024. I'm going to get to those 10 stocks I'm buying for the next year next, but if you want to see the 5 stocks I'm buying for the next 30 years, my forever stocks, look for the link I'll leave in the description below. It's a free report I put together with the Motley Fool, some of the biggest stocks in my portfolio. This report is totally free. You're going to see the first stock immediately, and they're going to email you that full report with the other stocks. It's an easy way to support the Let's Talk Money community, so I appreciate that, and see some of my favorite stocks to buy. So look for that link. Nation, behind all the analysis and stock picking we can do for 2024, there's really only 2 questions you need to answer. Where will inflation be, and how far and when will the Fed start cutting its interest rates? Those 2 questions are intertwined, though, because inflation is what's going to drive those rate cuts, so we're going to look at that first. first. Here we see the CPI, the Consumer Price Index of inflation, year-over-year numbers over the last 5 years, and you can see that giant leap it made, up 9%, almost 9% annual inflation rate there in June 2022, and see how fast that has come down. Now, I know a lot of you out there, you're saying, hey, just a minute, there is still inflation, prices are still higher. Yes, they are still higher, but look at the rate of inflation, how much inflation is going up each year. And right here in November, we saw 3.1% inflation year over year. So that means over the last year to November, prices only went up 3.1%. That was a lot better than the 9% rate of inflation we saw there in June, and has really helped the Fed kind of come off of its interest rate hikes. Okay, the Fed has been on pause there since mid-year this year. Just recently, over the last couple of days, has talked about cutting rates, has talked about starting to cut rates there in 2024. That's going to bring those interest rates down and really support this market. And one of the big surprises, I think, still coming for inflation is that it will start coming down faster than everyone expects. Already people are expecting the interest or inflation rate to come down to about the Fed's target of about 2.5% by the end of the year. That's going to help the Fed start those rate cuts. But I think you see here in rent prices, okay, rent is about a third of the CPI, of that Consumer Price Index measure of inflation. So it is very much the leading indicator for inflation and where inflation is going to go. So if we look here, we can see that the Labor Department here in red, how it measures rent is very much lagging. It measures rent prices, that have changed over the last year. But if you get a quicker measure from Zillow, so if you actually look on Zillow, they have data available that shows where rent prices have gone on a year-over-year, month-over-month basis, and you can see that the inflation for rent prices has come way down, really to historical standards, just over the last couple of months. That is not yet reflected in the Labor Department's measure of inflation that's being used in that CPI. So part of that 3.1% inflation that we saw in the CPI year over year, that is obscured by this lagging measure of inflation, of rent inflation by the Labor Department. That is going to continue to come down as it reflects more reality, more that short-term, near-term reality that we're seeing on Zillow rents. That's going to gradually bring inflation down, and I think faster than the market anticipates right now. And of course, that slower pace of inflation is what's driving the Fed's expectation for inflation, and the fact that they have now started to say that they're going to cut rates here in 2024. We're looking here at the Fed dot plot. So the Fed members' estimates of inflation for over the next year, they now do expect end of 2023 inflation to be right around 2.7 to 2.8%. You can see the little dashed lines here was the September projections. So here we have the December projections here in the blue bars. You can see that the Fed's own measures or own expectations for inflation have come way down just since September. And then you can look at 2024 here, where they now expect inflation to be right around 2.1 to 2.3% by the end of 2024. That is going to be very close to the Fed's neutral rate of inflation, where they want to see it right around 2%. That is going to allow them to lower rates just as fast as they increased rates a couple of years ago. I think that's going to surprise the market and is really going to support stocks higher. Folks, I know studying inflation is only interesting to economic nerds like myself, but this is everything for stocks right now because it is driving those interest rates and the Fed. Most investors just don't realize how devastating the Fed's fastest interest rate hikes in 40 years have been on certain stocks that we'll talk about next. Hiking interest rates from almost 0 to 5% in less than 2 years, it's unheard of and just destroyed stock valuations. And now with that lower inflation, we can see what the market is expecting the Fed to do. Here we are on the CME Fed Watch tool, a great free resource there online to show you market-based expectations. So this takes the trading in the futures markets for interest rates, kind of gives us a market-based expectation of what the Fed is expected to do over its next meetings. We can see here that we just had our December meeting here yesterday. Big news on that. We have 48 days left to go for the next meeting. If we scroll down here, we can see the probabilities here, what the market is pricing in for those interest rates or for those meetings for each Fed meeting. And we can see here the market now expects, after yesterday's very surprising meeting where the Fed started talking about those interest rate cuts, we can see that now the market expects the Fed to stay on hold through this January meeting before it was expecting maybe a rate cut there or a rate increase in January, the last one. But now the market does expect here in this blue 79% odds that the Fed stays on hold and then could start cutting interest rates as early as March of next year. Actually, 67, almost 85% odds that the Fed starts cutting interest rates in March of next year. That would be very early. We can see that it expects 1, 2, 3, 4, 5, 6, upwards of 6 interest rate cuts by the Fed next year. That is going to drive stock valuations just like we've seen the stock valuations tumble since 2021, since really the Fed started its interest rate hikes. We're going to see that reversed here in 2024, and I think it is really going to drive this bull market faster. Last chart I want to show you, and then we'll get to those 10 stocks I'm buying now, really based on all of these assumptions. And we can see here the rate cut cycle back to 1990. So this is every time the Fed has increased rates, paused on their rate hikes, and then started cutting rates, what the market for stocks, bonds, and cash have done during those periods. And we can see kind of a replay of what we saw here over the last couple of years. We can see there in 2022 and 2021, the equities here on average did about 6 to 7% return, but you were much better off just sitting in cash. You had a risk-free return in those money market funds, upwards of almost 5% return. We saw that last year with the Fed raising interest rates, really increasing those interest rates, pulling investors out of stocks and into some of those risk-free assets like treasuries and like money market funds. Now, this year, 2023, we've seen that rate pause period. Here we see that's when stocks really started to boom higher, up 21% on average since 1990, and we really saw that this year. S&P 500 up a little over 20% so far this year as the Fed goes on hold, stops raising interest rates, and really the market starts expecting those rate cuts and starts pricing in that higher valuation for stocks. Then when the Fed does start cutting rates, which we'll see here in 2024, I think this is what we're going to see here next year. You're going to see here the 6 months after the first cut, back to 1990, the average is about almost 15% upside for stocks. We do see it's a little bit lower than that rate pause period, but I think you've got a lot of surprise coming here in 2024 as the Fed does start cutting rates, as those valuations, especially for growth stocks and things we're going to talk about here next, start getting revalued higher. And that outlook for rate cuts is really driving a lot of these stocks I'm going to buy. We're going to start off with solar stocks here that have been crushed over the last year. We can go here to the 5-year chart and see that Enphase, really the leader in solar stocks, down from $320 in November of 2022. So really, as those rate cuts really started biting on some of these growth stocks, down to $107 a share now, really over the last couple of days though, as we started to see the Fed come forward and say, hey, we're definitely on hold so far and going to be cutting rates next year, up from $97 up to $120. So more than a 20% return just in the last couple of days, up 7.8% today. And I think you continue to see this stock run. Now, for each stock we look at, I'm also going to be adding a broader exchange traded fund, an ETF that covers that theme. This is going to give us the opportunity to buy one stock in each theme. Here in solar, we bought shares of Enphase, ticker ENPH. For the solar energy theme, though, we want to look at the Invesco Solar ETF, the ticker TAN. What this is going to do, it's going to give us the upside on that single stock, but also that broader upside across the entire sector. I think that's where really the news is going to be across the broader sectors in these, or broader industries within these themes. We saw solar just absolutely crushed over the last year as those interest rates really started, brought down the valuations on these growth stocks. That's going to be a big part of it. These growth stocks with their cash flows far off into the future, when you're using a discounted cash flow multiple or discounted cash flow valuation to value what the present value of these stocks are, what the per share price should be, then you take those future cash flows and you discount them by an interest rate. As that interest rate goes up, the present value decreases on that. So you saw all of these growth stocks in solar, in electric vehicles, in a lot of these other growth themes really come crashing down over the last year. That's one. Another reason why these solar stocks got hit, and we'll see this next with EV stocks as well with the higher interest rates. Very few people are buying these with cash only. They're going to charge it and put on a lot of debt to get those solar panels on their house. Those higher interest rates are are obviously going to mean this is much more expensive with those higher interest charges. So we started to see some revenue weakness in a lot of these names. Again, as those interest rates start coming down, you're going to see higher revenue estimates for these solar companies. Now, one thing I want to do, like I said, adding these ETFs, these broad industry level ETFs to these, one thing you can do if you don't want the stock that I talk about, like Enphase, you can go here to holdings and you can see what stocks are in these broad sector or broad industry ETFs. So you can see here in this TAN, this Invesco Solar ETF, what stocks it's holding. Pick out one of these stocks from the theme and then invest broadly across the ETF. So you can see here First Solar, ticker FSLR, is about 10% of this. Enphase Energy, ENPH, also about 10% of this fund. Solar Edge Technologies, Sunrun, all of these probably very good bets as we see those interest rates start coming down and you start seeing those revenues jump for these solar stocks once again. Also buying into the EV theme, the electric vehicles. This has also taken a big hit over the last year just on higher prices for electric vehicles. Obviously, higher interest rates means higher interest expense to buy an electric vehicle, or a lot of these. That's brought down the demand for a lot of those cars, as well as related companies like ChargePoint Holdings here. Now, I think ChargePoint Holdings has a prime opportunity here. It has the dominant market share in charging stations here across the U.S. Actually did see just recently Starbucks is using ChargePoint Holdings to install charging capacity at its stores. Can you imagine if every Starbucks had ChargePoint Holdings at its store to let people recharge their electric vehicles? That would be a huge revenue run for ChargePoint. We're also seeing funds from the Inflation Reduction Act, the IRA, which was a horribly named policy. But anyway, we're going to start seeing billions of dollars for that policy come through to the charging companies to build the infrastructure across the United States. ChargePoint Holdings doesn't have any debt due till 2028, has almost $500 million in cash liquidity that they can use to maintain those operations until revenues really start jumping. I think ChargePoint here you see up 18% just today, up another 12% yesterday. It's doing very well. I think you see this stock back up to about $5 a share over the next year. For that broader ETF in the electric vehicles theme, also looking at the Global X Autonomous and EV ETF, that's the ticker DRIV. We can see here in the holdings, see which stocks it's owning. We can see a lot of it is in those chip makers, Intel, Alphabet, NVIDIA. So not necessarily direct plays on electric vehicles, but it does own shares of Tesla. It's going to own shares of ChargePoint and some of those other EV related stocks. This is very much a autonomous vehicle ETF rather than the electric vehicles ETF. So I might, instead of going with this ETF, go with several of the electric vehicles, more directly related electric vehicle stocks like ChargePoint, like Tesla. I also own shares of Rivian. I think it's a great truck maker. I think with a lot of the companies, especially Ford, delaying its production plans for that F-150 Lightning because of the drop in demand for electric vehicles this year, I think that is a prime opportunity for Rivian to really take market share for those larger truck EVs. Looking at that real estate theme, and again, I think this is one of the major opportunities here for 2024. We saw the entire industry, the entire real estate sector just drop off a cliff last year, down 25%, underperforming this year, up only 2%. And again, a lot of that is that interest rate story, okay? Driving down the cash flows, driving up the interest expense for these real estate managers. We saw the biggest weakness here in shares of medical property owners. So real estate investment trusts that own those hospital real estate areas that they lease back to the hospitals because of the weakness in hospitals as well as real estate. One of the stocks that I've been holding for a while is Medical Properties Trust, ticker MPW. You can see it's up 11% today. It was up another 10% yesterday just on the news that the Fed is going to start cutting rates next year. I think you're going to see a very strong performance here in Medical Properties Trust, ticker MPW, as well as all of these real estate names. So bringing that out into the broader picture here with the Vanguard Real Estate Index Fund, the ticker VNQ, we can see how that has done since 2021, really the start of that Fed-related or Fed-induced sell-off down from 116 has really jumped over the past couple of days, but still only $90 a share. This one pays a 4.4% dividend yield, so very healthy dividend yield as you wait for the shares to get back up to that $110, $120 per share price. Looking here at the holdings for the ETF, we can see that it is fairly well diversified diversified across all the real estate investment trusts out there. It does own a lot of office property REITs, so you might want to hedge that a little bit. Maybe go with another ETF that doesn't hold quite so much office property, but I think you can do very well just in the broader based theme here. It owns Prologis, American Tower Corporation, ticker AMT, I think can do very well. We were already in shares of a CCI, Crown Castle, up about 30% just over the last month in shares of Crown Castle, but also data center REITs like Equinix, Welltower, another healthcare REIT there that'll do very well, Public Storage, Simon Property Group, a retail REIT, as well as Digital Realty Trust, all very big names within that REIT. Next to real estate, I think regional banks is probably your second best opportunity here in 2024. We saw how those banks sold off really in that March crisis on interest rates. I think investors are going to be extremely surprised when those interest rates do start coming down, how much of a bounce back those regional banks are going to get. Now, I am adding shares of SoFi Technologies, already up just over the past couple of days from $8 a share almost to $10 a share. It hit $10 a share earlier today. This is one of the best positioned fintech companies, so not your traditional regional bank, but I still do like it better than most other regional banks. If you are looking at a more traditional regional bank, we're going to look at that in the ETF that we look at next. But I think SoFi Technologies really, apart from a lot of the other regional banks that saw their deposits fall there in that March crisis, really one of the few that actually saw deposits rise, as well as interest expense and all those things that make it a legitimate bank here in the next couple of years. Here with the broader picture on those regional banks, we can see here the iShares U.S. Regional Bank ETF, ticker IAT, up 10% just in the last couple of days, as we do start seeing that the Fed is going to start cutting interest rates. So I think you're seeing the market already front run this opportunity for 2024, already saying that, hey, we did see the higher interest rates really kill the bond valuations in those bond portfolios regional banks are holding. It really spooked investors. Now when we start seeing those interest rates start coming down, what's that going to do to regional banks? It is going to work the opposite effect, and you're going to see these back to their peaks. We can see here in February of last year, this one peaked out at about $64 a barrel, so it is still well below that. You can see just in this year here, regional banks still, even after the sharp return over the past couple of days and over the past month, it is still well below the $49.50 price per share it had just this year. Looking in the holdings for the regional bank ETF here, give you some ideas of individual regional banks. You might look at U.S. Bank, obviously the biggest portion of this ETF, 15% of assets, the largest regional bank by deposits and assets. Really not necessarily a regional bank because this one is so big. It's probably about the fourth or fifth largest bank in the United States. Other regional banks here, though: Truist, M&T, Fifth Third, First Citizens Bank shares, Class A shares, Huntington Bank shares, regional, really like Regional Financial Corporation here, ticker RF, as well as Citizens Financial Group, ticker CFG. Both regional banks. I think if you don't want that SoFi play, maybe you can go with some of these other regional banks. KeyCorp, also a very good regional bank there, ticker KEY. We're going to get to that last sector and the opportunities in 2024. All these stocks have double-digit upside potential for 2024, but if you want even better returns, watch this video here next for my 3 favorite options investing strategies for next year. These option strategies will not only boost your returns, also going to show you how to protect your downside risk, so check that out. Another one of your best opportunities there in utility stocks. Remember, the entire utility sector down more than 10% over the last year, really as those investors exited those dividend plays for higher yields, higher returns in just cash and cash money market accounts, up to 5% in a lot of cash money market accounts. Really didn't make these dividend plays in utilities seem anything special. I think you're going to see just the exact opposite of that when we start seeing those interest rates start coming down. You're going to start seeing those money market yields, those returns on cash just crash. The treasury yields coming down. Treasury yields already down from 5% down to 4% just over the last month. I think you're going to see those crash further. You're going to see money market accounts only yielding maybe 3.5% at the most towards the end of the year. Then investors are going to take another look at these utility stocks. These stocks or companies with very stable cash flows, very stable revenues, because they are regulated. You're going to start seeing these dividend yields look much better. Here we see AES Corporation, ticker AES, with a 3.5% dividend yield. That plus the upside return for this stock. You can see here over the last year, it is down almost about 30%, down from $28 per share back there in December of last year, down to about 20 cents a share, or $20 a share. Over the past couple of days, you have seen a big snapback in a lot of these utility companies as investors start trying to front run this idea, start thinking forward and saying, hey, yeah, these dividend yields are going to look very good when cash money market accounts are back down to 3 and 3.5%. Investors are going to rush in, going to push up the prices on these stocks. So they want to be early. If you want to be early into these stocks, a broader investment idea in this ETF, the Utility Select Sector Spider ETF, you can see over the past year, it is down from about $70 down to $66 a share here, offering a 3.4% dividend yield. And you can look in the holdings here, see the different stocks held in this. And Next Era Energy, a big part of it, 12.9%. Southern Company, 8.4% of this stock. Southern, ticker SO. Duke Energy, ticker DUK. Sempra, you got American Electric Power, ticker AEP. All of these very strong utility companies that are going to provide that high dividend yield plus the price appreciation upside. Get your free report, The Stocks I'm Buying for the Next 30 Years, my forever stocks, free with the link below. Or click on the video to the right for my 3 favorite option strategies for 2024. Option strategies that will not only boost your returns, but protect your downside. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.